$14 billion in cargo is missing. And the Port of Los Angeles is seeing a significant drop in shipments. China hasn't flinched. Instead, the tariffs imposed by President Trump on April 2nd, which raised duties on Chinese goods to 145%, sparked a drastic response from Beijing, cutting off nearly half of the Port of Los Angeles' traffic. This wasn't caused by a disaster or cyber attack, but by a single economic decision that's affecting American retailers, importers, and the global supply chain. If you found this video insightful, don't forget to hit that subscribe button. Stay tuned for more updates and content. We've got plenty more coming your way. Gene Soroka, executive director of the Port of Los Angeles, reported that the next week's cargo volume is expected to fall by over 35% year over year.
Gene Soroka says Trump's tariffs will cause shipments from China to drop by 35% next week.
Hub of imports will be down by more than 35%.
Marking a drop of approximately $10 billion in merchandise. According to Reuters, major U.S. retailers have already halted shipments from China, and the consequences are starting to show. The tariffs were supposed to force China back to the negotiating table, but instead they've resulted in a silent response from Beijing, pushing U.S. importers into a financial crisis. Bloomberg shipping data reveals that outbound vessels from Chinese ports to the U.S. West Coast have dropped by 40% since early April. This drop, which includes 320,000 containers, has left many shipments stranded at origin, creating a massive backlog. Jim Gerson, owner of Gerson's Companies, a major supplier for retailers, shared that his business, which depends on China for over half of its inventory, has 250 containers stuck with goods worth tens of millions of dollars. He faces a critical timing issue. If products like Halloween, Thanksgiving, and Christmas items aren't shipped in the next few weeks, they will be worthless. Retailers have just 5 to 7 weeks of inventory left before stock shortages and price hikes begin to affect consumers. Soroka warned that the impact won't be immediately visible on store shelves, but will first show up as missing variety. The shipping issues are already rippling across major retailers like Walmart and Target, who have alerted the administration that higher prices and limited selection are inevitable. According to a Bloomberg survey, U.S. imports are expected to fall by 7% annually in Q2 2025, the sharpest drop since the COVID-19 pandemic. As the back-to-school season approaches, toy suppliers like J. Foreman's company, Basic Fun, which relies on China for 90% of its products, are bracing for cancellations, especially if the tariffs remain. If you found this video insightful, don't forget to hit that subscribe button. Stay tuned for more updates and content. We've got plenty more coming your way. The disruption isn't just a supply chain problem, it's a potential logistical shutdown. Lars Jensen, CEO of Vespucci Maritime, noted that reopening trade flows after a sudden halt doesn't restore normalcy. Instead, it creates bottlenecks. As ports struggle to recover from the backlog, many expect a similar surge in prices and delays once trade restarts. April saw a 60% increase in canceled sailings from China to the U.S. compared to the worst months of the pandemic. The shipping industry is already adjusting, but ports in Southeast Asia, which are seeing an influx of rerouted shipments, don't have the infrastructure to handle China's volume quickly. This disruption is leaving businesses with fewer options and soon higher costs. The trade slowdown is also taking a toll on American workers. With imports from China plummeting, the labor market in trucking, logistics, and retail is facing layoffs. According to economist Torsten Slok, reduced Chinese imports could cause a ripple effect, affecting industries across the economy. The World Trade Organization forecasts an 80% drop in goods traded between the U.S. and China if this situation continues. With retailers facing the prospect of empty shelves during the crucial holiday season, the long-term effects of this tariff freeze are beginning to unfold. The $14 billion cargo shutdown is a stark reminder that trade wars come with consequences that reach far beyond the economy. They impact jobs, supply chains, and consumers. The question remains, who will pay the higher price? Beijing or Main Street America? If the US-China standoff continues through the summer, the real cost might not just be cargo, but potentially a $500 billion credit freeze or a devaluation of the dollar. Drop your thoughts in the comments, and don't forget like and subscribe for the latest updates on global politics.